Informed people know that if you spend money on certain things, you can get a tax break. In real estate, you don't even have to spend the money to get a tax break. Hi, I'm Keith Weinhold. This is Get Rich Education. Welcome into video number 4 out of 5 in this short course video series on the 5 ways that real estate investing pays you. This is about tax benefits.
Average Joe invested in real estate and became a boss. Ever compared investments and wondered, what makes real estate special? Inflation will be your new best friend, and you'll be increasing income while decreasing taxes because debt-free is dumb, compound interest is lame, the US dollar is fake, and real estate is real. Real estate simultaneously pays 5 ways.
Rental property is taxed at ordinary income tax rates. However, the tax deductions are generous such that you don't need to pay tax on the majority of your rent income much of the time. Let me give you an example of a tax deduction because it's something I find people misunderstand at times. If you have an annual income of $100,000 and you get a $10,000 tax deduction, it's not a $10,000 benefit to you. What that would do instead is lower your taxable income from $100K down to $90K. Consequently, you would only be taxed on $90,000 rather than $100,000. And if you are in the 24% tax bracket, therefore, that $10,000 tax deduction would save you $2,400 that year. That's what a tax deduction means. You also hear people call it a tax write-off. A write-off and a deduction are the same thing. So if you write off $10,000 in a year and you're in the 24% tax bracket, your net benefit is not $10,000, it's $2,400. That's a tax deduction. Now, from your rental property, you can deduct your mortgage interest, many of your operating expenses, a tax depreciation deduction, which is really special, and finally, you can endlessly defer your capital gains tax such that you never have to pay it. Rental property taxes are complicated, so I'm not going to be able to describe this with the completeness that I was in some of the other modules, but if we go ahead and take a look at this example, and we're going to continue to use this example of a $100,000 single-family rental home, and you'll notice that I continue to pull these expenses from video 2 of our 5-part video series in order to stay congruent. Remember, you had $12,000 of annual rent income because you're renting this single-family home for $1,000 a month. And then let's deduct out some of these deductible operating expenses in addition to the mortgage interest. So we're deducting out $3,200 from the mortgage interest, $1,000 for property insurance, $1,400 for property tax, $1,200 for a property management expense, and then we'll deduct out $1,000 for some of the other deductible expenses that you might have, maybe a piece of equipment or maybe an educational conference that you flew to that had something to do with real estate investing. And we come out with this subtotal of $4,200. Hey, that's pretty special. Okay, well, what does this $4,200 mean thus far? Thus far, going on in the calculations, you're not being taxed on all $12,000 of that rental income in the top line. Yeah, you're only being taxed on the $4,200 portion, which is just a little over a third of that. Why? Because you have a number of tax deductions that we just subtracted out. It gets better. In addition to all this, there is also that aforementioned tax depreciation deduction where you don't even need to make a real expense in order to get this deduction called depreciation, even though the property appreciated at the same time. In our example, you get to take depreciation every year regardless of what happens with property values. So let's apply this special tax depreciation deduction. You have this 100K property. We'll say that $75,000 of it is what's called the improvements, meaning generally the structure itself, and then $25,000 of this property value is in the land. All right, well, even the IRS knows that land does not wear out over time, so that's excluded from the depreciation deduction. And the IRS wants to give you this benefit because they're going to say that over 27 and a half years that the property depreciates down to nothing and everything wears out. So that's why you get this sort of phantom deduction without having to make any expense. So therefore, what you do with your $75,000 house, not the land, is deduct 1/27.5 of the value. Yeah, isn't that an awkward fraction to say or look at? Which means that $2,727, as it turns out, can be deducted in addition to these operating and mortgage interest expense deductions that we already made. This can be deducted off of your rent income. Another way to think of that fraction, 1/27.5, is that's about 3.6%. So about 3.6% of this $75,000 comes out to this $2,727 tax depreciation deduction. And is it even fair to call tax breaks returns like with what we're doing here in this series? Yes, it is, because you did not have to spend any money in order to get this particular depreciation deduction like you would have if you had conference fees and travel. It's just like you spent $2,727 in a piece of equipment or going to a conference, but you didn't even have to do that thing. And yes, you get this deduction every year for 27 and a half years. So now your total taxable income, as we go back and look at the numbers here, is that $4,200 minus this $2,727 depreciation tax deduction that you got. That comes down to $1,473. So there it is. Of your total annual rent income of $12,000, in the eyes of the IRS, it's only $1,473 then that gets taxed. That's a beautiful thing. So then your rent income is about 8 times the amount that the IRS can claw at for taxable income. Only about 1/8 is taxable income. So if you're in that 24% marginal income tax bracket, like I mentioned earlier, your tax obligation would then be 24% of only that $1,473, and you would only owe about $354 on that $12,000 of total annual rent revenue. That's an effective tax rate of 3% right there. Hey, put a like on this if you're getting some value out of the video. I'd really appreciate that. It also tells me you kind of like these generous tax deductions that the IRS gives you. They want to incentivize people to promote housing for others, and this is one of the ways that they do that. And there are more benefits and taxes that we're just not going to have time to get into because it really involves a lot more numbers and some things. I want to go over some of the main ones with you, but there's also qualified business income, a deduction for that. There is something called bonus depreciation. There's something called a cost segregation that you can do to step up your write-offs. We're not going to get into all that. And there's even more to consider here, like what your marginal income tax bracket is. That's something that I don't know. And then there are often income thresholds and different thresholds, whether you're married or single. And there sure are an awful lot of it depends factors. So I'm going to stay straightforward and stick to the main tax benefits that you get here. So then understand that it is more complicated to apply an ROI from tax benefits into your sample $100,000 single family home here in this fourth of our 5 profit centers, but I'm just going to conservatively call it 5%. Now, I know we've got some CPAs watching this right now thinking, come on, it's substantially more than 5%. How can you call it only 5%? Well, first of all, I like to run these numbers fairly conservatively. And also, either you're tracking this yourself or you have a bookkeeper that you would have to pay to track these for you. So I'm really in deference onto something I like to call your ROTI, your return on time invested. If this takes some of your time, I want to factor that in somehow. Now you, if you're a beginning real estate investor, and the way that I started out is that I would use Schedule E, which is what you use on your tax return in the United States, to go ahead and use as a worksheet for these deductions. Today, I have property managers in various cities, and the property managers just report this information right to my bookkeeper, but that incurs some small expense. By the way, I'm wearing a red shirt for this video. I guess this is somewhat patriotic, so I was going to choose either red, white, or blue, and the government gives you tax incentives for being a red-blooded American that provides housing to other people, because the government knows that individuals and private enterprise typically do that more efficiently than government housing. Now, I do still want to discuss two important taxes that are incurred to you when you sell the property, unless you do this one thing I'll tell you about, and you can get out of both of them. Number one is depreciation recapture. So when you sell the property, you would have to pay back to the IRS depreciation recapture. We calculated it was $2,727 in this particular example. Yeah, the IRS wants that back when you sell the property. And this second tax at sale time is a capital gains tax. So the way a capital gains tax works is, since in our example property, say you bought it for 100K and over a number of years you sell it for 200K, well, your gain or your profit, that capital gain, is $100,000. At a 15% long-term capital gains tax rate, which is what most people would pay, that would mean that you only get to keep 85K of that 100K gain, not the entire thing. And your long-term capital gains tax obligation would be $15,000. However, real estate investors have another break where you don't have to pay either depreciation recapture or any capital gains tax at all. You're able to defer it endlessly over and over if you continue to trade your sale property up for generally more and larger properties. Both of those things are written off. You are exempt then from paying either of those things, depreciation recapture or capital gains tax. In fact, as a nearly 19-year real estate investor now, I've never paid a dime in capital gains tax or depreciation recapture legally from my real estate, because I do these 1031 like-kind exchanges, also known as 1031 tax-deferred exchanges. And what is the source of this benefit? You know how I talked about in the first video, the source of the appreciation benefit was the market and the bank's money that you're leveraging. In the second and third videos, the cash flow and the return on amortization, that was coming from the tenant. This fourth benefit clearly comes from the government. And although we had some more numbers floating around here in this one, a great thing to remember about real estate numbers is you don't ever have to do any complicated math. Not once in my life with real estate have I done any trigonometry or calculus. I've never used exponents to try to have to figure out anything. It's just addition, subtraction, multiplication, and division. Those are really the only four operations that you need to use. However, it's just knowing what formula to use and what formula to apply. The math is simple. So here we go. Let's tally it up on the scorecard. Remember from back in the first module, we had 30% in a return from leverage appreciation, 6% from cash flow, 6% from your return on amortization, plus 5% in tax benefits here. We're up to a cumulative total of a 47% year one return on investment. Stay tuned for the cliffhanging conclusion when I bring you the final video, the fifth of 5 ways that you're paid in real estate investing. My name's Keith Weinhold. Thanks so much for stopping by.